Hi, my name is Brian Harris of Ventura, California. I'm a mortgage broker. Today I wanted to talk to you about the CalHFA Dream for All Shared Appreciation Loan. You may have heard about this program in the news. It's for California residents. You're a first-time home buyer. You'll be given 20% of the purchase price that can go towards your down payment and closing costs. So on the surface, it sounds awesome. Why wouldn't you get it? So, you may want to. You very well may want to. So, what I'm going to do a quick overview of the program, and then I'm going to compare this loan next to a regular conventional low down payment loan, and show you in a couple different scenarios, how the two look. So, my goal here is just to give you information, not to push you one way or another. I can do the CalHFA loan. I can do the regular conventional loan. So hopefully you find this information valuable. Without further ado, let's get started. I'll begin with an overview. The Dream for All loan is a shared appreciation second. So it goes behind your first mortgage. It's going to be for 20% of your purchase price. You do not have a monthly payment attached to the second. It does not affect your debt to income ratio, so it does not affect your ability to qualify. The way it works is when you sell, refinance, you pay off the loan, the shared appreciation loan is due, so you pay it back plus 20% of the appreciation. So in a few seconds, I'll explain to you how the appreciation is calculated, and then I have in brackets 15%. I'll explain the situation where you only pay 15% of the appreciation instead of 20. But generally, that's how it's going to work. You're going to pay back when you sell or refinance the loan you were given plus 20% of the appreciation. Here's some of the requirements to qualify. You need to be a first-time home buyer, and all the borrowers need to be a first-time home buyer. So there's some programs where if one of the borrowers is a first-time home buyer, you're good. In this case, all the borrowers need to be first-time home buyers. You need to occupy the property, so you can't have a co-signer who's not going to live with you. So everyone needs to be a first-time home buyer and needs to live in a house and needs to be a primary resident. There's income limits, which I'll go over shortly. There's FICO limits, so you need to have a 680 FICO unless you're under 80% of the area median income, which I'll discuss more shortly. Keep saying that. Then you could be 660, but for most people, you're going to need to have a 680 FICO. If you're 700 or better FICO, you can have a 50% debt to income ratio. Otherwise, you have to have a 45% max DTI. And there's a home buyer education class required. So that's going to cost about $99, and they say it's about 8 hours. That might be actually longer than it is, but I think that's a good thing. But it's first-time home buyers are getting into this kind of weird loan, so it does require that you attend an online home buyer education class. So how is the appreciation calculated? Okay, if you sell the house, it's going to be based on your purchase price and your sales price. So I wrote a few reminders here to talk about. So there's you might have capital gains. It's not based on your taxes and your capital gains. Like if you put money into the house, that's not factored in to the appreciation. So you put a new roof, you do all this stuff. They're just going to look at your purchase price and your sales price and see how much it's appreciated. So big renovations, if you want to buy a fixer-upper, probably not the loan for you, because the appreciation loan is going to be based on the appreciation and not the appreciation over and above what you've put into the house. When you sell, the seller typically will pay the commissions for both agents, for buyers and sellers agents. So it's not a netted out amount. It's again, purchase price, sales price. And then in this scenario where you refinance, and the loan becomes due, it's going to be based on the purchase price and the appraisal on the refinance. So that's how the appreciation is calculated. So here's an example. A lot of people are visual. So this is from CalHFA's website. In this scenario, there's a $500,000 house. That 20% second was $100,000. The house appreciated from $500 to $640. So that's a 28% increase. So one way to look at it is like that 100,000 grew to 128. You can also see there was $140,000 of appreciation. 20% of that is $28,000. So when they sold the house, they paid back the $100,000 they borrowed plus 20% of the appreciation. Gets them to $128,000 payback. They keep all the rest. And then you can see in that third house there, the funds CalHFA receives, they're recycled into additional loans that are made. My understanding is that there's $300 million earmarked for this program. So I'm not sure how long that will last. I would think months, but not years. We'll see what happens, when we reach that point. It's available today, but this is a nice visual for those who like charts like this. I wanted to briefly touch on income limits. So you need to be under a certain level of income to qualify for the Dream for All loan. It's county based. You can see here I have a website which you can reference should they ever change in the future, and then I've pasted here what they are today. Picking where I live, Ventura County, the income limit's $228,000. So that's not household income, that's qualifying income for the people on the loan. So if you have qualifying income on your loan of $228,000 or less, then you're eligible for this loan program. There's one other thing income related I wanted to touch on, and that is 80% of your area median income. So again, post the website. You can also just do a Google search or something like Fannie Mae, AMI, income. You can punch in an address. You can also punch in a zip code or a city. Address is probably the best way to go. And you will see what your area median income is, and most importantly, what 80% of your area median income is. And as it relates to this loan, if you are under 80%, then you only have to pay back 15% of the appreciation versus 20%. And you're also able to have a 660 FICO versus a 680 FICO. So a couple of benefits to being under that 80% qualifying income on this loan. Next, my goal is to compare a regular conventional loan to the shared appreciation loan. Now, knowing a lot of you are first-time home buyers and haven't been through this process before, in addition to your down payment, you need to pay for closing costs and prepaid expenses. So I'm going to list those out here. They're not going to be exact, but it'll get you in the right neighborhood. Okay, so big ones will be origination, appraisal, title, escrow, and then there's credit report, notary, recording. I don't know exactly what title and escrow company you're going to use, but this will be in the right neighborhood of costs. Same with origination. These aren't exact numbers, but they're good estimates. Okay, so now you know generally what those closing costs will be. And these closing costs, these are going to be your cost of this transaction. All right, but also you need to prepay some items. So there's prepaid expenses. So you have prepaid interest is interest for the days left in the month you close. I don't know if you're going to close at the beginning of the month or the end of the month, so I'm just going to assume it's the middle of the month. You need to pay for the first year of homeowners insurance, about $100 a month, $1,200 for the year. You're going to have to prepay that. There's taxes and insurance. You have to pay several months of those each. Okay, so upfront. So if you total this all up, it's about $13,000 for a $700,000 purchase. They're going to have to pay in closing costs and prepaid expenses. Now, what's different about the shared appreciation loan and the CalHFA loan is that on a typical loan, there's what's called lender paid comp. That means you do the loan, and after it closes, the lender will pay the bank, they'll pay the loan officer and his company, his or her company. But for the CalHFA loan, they don't do that, so you have to charge an additional borrower paid comp. So that could be anywhere from like 1.5% to 2.25%. So I'm just going to assume 2%. And when that's added, the total cost with closing costs, prepaid expenses, and borrower paid comp could be about $25,000. So the first sort of negative for this CalHFA loan is that it's going to be more expensive. So this would be about 2% more expensive in closing costs, but you're given 20%. So, although it's not a gift, it's a loan. So, you're charged more, but, they give you that 20%. So that's sort of the trade-off. So we use this information as we go on, but I wanted to explain why the closing costs are higher for the CalHFA loan, and it's because they have borrower paid comp. So that doesn't all go to the loan officer. It goes to the loan officer, goes to, their company, goes to the processor. It could be dock jars. There's a lot of hands out, being paid by this loan. So typically, it's all included in the rate. For this CalHFA loan, it's not. So there's a separate borrower paid compensation. Okay, so that leads us to our loan setup. So we're looking at a $700,000 purchase. For the CalHFAs, there's that $25,000 in closing costs, and for the regular loan, there's $13,000. Okay, so this first option, we're saying there's nothing out of pocket. So you're going to get that 20%, which is $140,000. Second, you're not coming out of pocket with any money, so you're not going to have a full 20% down, because that 20% second goes towards your down and your closing costs. So you're going to start out at about 83.6% loan to value. Now, if you get that 20%, you want it all to go to your down payment, you're going to come in with $25,000. Okay, so you're going to come in with $25,000, and you're going to start with 20% down, no mortgage insurance for you. And the third option is a 3% conventional loan. And you have, so that $21,000 is that 3% plus the 13 in closing costs. So you're coming out of pocket with $34,000. You have a regular old conventional loan. Let's talk about the rates for this CalHFA loan. So there's a Dream for All conventional loan that has to sort of be ahead of the second. Here's the website where you can look up every day what the loan rate is, what the mortgage rate is. So when I looked, it's a little blurred out, but it was 6.375. And then if you're under that 80% area median income, talked about a second ago, it's a little better at 6.25. Okay, so 6.375 is what we're going to use in our example. Now I just searched for a borrower who has like prime credit, so I'm going to assume like in this scenario you all have great credit. Maybe you don't, but I have to make some assumptions here. This is not a rate quote in any way. No way. This is just, I'm trying to help, trying to give you information. This is not a rate quote. Okay, so what I saw for like the prime guy or girl has 3% down, 5.999 is the rate I was seeing. Okay, so we're going to use that in our example because that's what I saw. Not a rate quote. So let's see what our payment's going to be here. Okay, so again, CalHFA zero out of pocket, 6.375. You have mortgage insurance, but I'm assuming you have great credit, so you can have $50 in mortgage insurance. In all these scenarios, because it's based on the price, the property tax will be the same. Also assuming your homeowner's insurance will be the same. So, it's just what's going to change is your mortgage and mortgage insurance. The second option, the loan's a little smaller, so the payment's less, and you have that 20% equity, so you don't have the mortgage insurance, so you get a little better payment on that middle option. And then the third option, 3% down, we're going with the 5.999, and you have even less equity, so you have a higher mortgage insurance rate because your loan to value is higher. So this is where you're starting off, and you can see right away, this is the benefit of the program, is that for the same purchase price, you can have a lower payment. So this CalHFA solves that. So really what it does for you is that it increases your purchasing power by roughly about 20%. So if previously you're approved for 500,000, now 20% of that is 100. Now you're approved for about 600,000. So it's going to increase your purchasing power. That's what this CalHFA shared appreciation loan is going to do. That's the big positive. It's going to increase your purchasing power, or for a set price, it's going to lower your payment. It's going to give you a lower payment. Initial payment. We're going to go over that shortly. It'll give you a better initial payment. This is the big positives for this program. Okay, the big positives, let's recap. Higher approval and lower payment for apples to apples price. So if you have, like here, 700,000 conventional versus CalHFA, your payment's less CalHFA initially. All right, let's go on. Okay, now here's something to think about. Starting point. How are you starting? Okay, so this CalHFA loan, it's zero out of pocket. You're gonna owe more than the house is worth. Okay, when you look at your first, your second, you're gonna owe $725,000. And things are only worth 700, so you're in the hole to begin with. Day one, you are underwater. If you come in with your closing costs, of course it's 100% financing, so you have no equity. So this is just a downside, or just not even a downside. It's something to be aware of. Okay, you don't have any equity to begin with, but you didn't put anything down. Why would you have equity, right? Okay, so it's just something to think about. So at least if you put 3% down, you have a little equity, a little bit of equity. Okay, your down payment, $21,000, equity. So now let's look at this. Fast forward a little bit. So first thing we'll look at is 2 years, 5% appreciation. This actually might be likely. This is very possible that we're not in this high return environment for real estate. Now, what about if prices go down? Well, you started with no equity. So if prices go down, you're underwater, which if you're not going to sell is fine, but you're sort of locked in there. And so you can't sell, and you'd be short selling because you're underwater. Okay. So it's just something to be aware of. Okay, now back to the example, 5% appreciation over 2 years. So let's say you decide to sell. Okay, so you decide to sell. I'm gonna assume it's gonna cost you 6% to sell. So again, a lot of you are first-time home buyers. The seller pays the seller's agent and the buyer's agent. So often it's 6%, sometimes it's 5%, but sometimes it's 6%. And also if it's 5%, there's also, transfer tax, title, there's costs to sell, move. So just to assume 6% is probably a safe bet. So you sell, get that 6% commission paid that you're paying in commission, nets out to $690 and change. Your mortgages are lower, so you pay off your mortgage with your proceeds. Then you've made 5%, so that's on 700,000. That's 35,000. So you went from 700 to 735. That's good, right? 20% of that is 7,000. So you borrowed 140,000 for 2 years on that second, and you paid 7,000 for it. Sorry, scratch my nose. So it's like 2.5% roughly a year for second position money. That's cheap money. It's really cheap. So I'd say you came out a winner, but we have a problem. Okay. you're underwater. So in this first option, you made some money on the house, but you would sell it, you would be short. Even if you came in the middle option with closing costs, you're short. You don't have any proceeds. You put 3% down, you have a little money to walk away with. So there's a scenario where prices go down and you're not able to sell. Prices go up a little bit and you're not able to sell. If they go down, you're not able to sell. Of course, you can always short sale or foreclose, and that's just bad. Not a good idea, but yeah, it's just something to be aware of. When it's dangers of starting out with this razor thin equity. Okay, so like I said, it works out at this scenario to about, you're paying 2.5% interest on that second, just 20% of the low appreciation. So that's cheap money. That's cool. What you want to do is just get out while you can. Get out of the shared appreciation loan. So you refinance out of it. So what I'm just showing you here is that you're going to refi the balance of your mortgage, plus you're going to pay off the shared appreciation loan, and I'm throwing in $5,000 in cost for the refi. So option one, you don't have the equity. Maybe someone can refi you there. I punched a scenario in, and I wasn't able to because it says loan to value too high. So again, you can't, even if rates were to drop, you couldn't refi to take advantage of them because without coming in with some money, because you don't have the equity. Okay, let's go on. So in the middle scenario here, okay, I punch it. I could do that. I can do a 95% loan to value refi. So you can get out of that shared appreciation loan, and you're on the home ownership. However, there's a catch. Let's even say rates dropped 1%. Because your loan amount you're lending on is going to increase, your payment's going to go up. Also, you had 80% loan to value to begin with. You didn't have mortgage insurance. Now you're 95. You have mortgage insurance now. So if you refinance, which you might want to in this scenario, just get out of that shared appreciation loan before it really takes off. Your payment's going to go up over $500 to refi out of the CalHFA loan. So I'm just giving you information, just things to be aware of. Okay, then looking at this last option here. So let's say rates dropped 1%. You could refi, lower your rate, lower your payment. Your mortgage insurance will reset lower because when you started, you only had 3% equity. Now you got almost 10, or you have 9. So you're going to be in a better bucket for mortgage insurance. So what you're going to do, you can refi, and your rate's going to drop, and your payment's going to drop about $400. So this is a good story. So when you're in this conventional regular, your mortgage payment is going to be it's set for, assuming it's a 30-year fixed, it's set, it's not going to go up. And if you refinance, it'll go down. So when you're in this CalHFA, you might refinance, get out of the shared appreciation, or just to lower your overall rate, but your payment's going to go up. You might add mortgage insurance. So it's just something to be aware of. Let's look at a different scenario with more appreciation. Okay, let's say after 5 years, you're up 25%. You're still in this loan. Let's look then you decide to sell. Okay, so this first option, again, we're taking 6% off for cost to sell. Your mortgages are lower because you've now paid 5 years on the mortgage. Now the shared appreciation is higher, so you made $175,000 in appreciation. So you're gonna have to pay 20% of that, which works out to about $35,000. So that's okay. You keep 80% and you give up 20. If you looked at this as a interest on your second, it'd be about 5% interest a year, roughly. Simple math. So again, that's second money, 5% today. That's pretty good. That's really good. So I wouldn't cry about it. It wasn't like a foolish thing to do. But just the way, the numbers work, you would come out with maybe in this first scenario, 100,000 versus the conventional loan, 3% down, almost 200,000 in proceeds. So, so just there's pluses and minuses to all this. I understand this whole time you've been paying less every month. So if you factor that in, that narrows this gap as well. But yeah, just if you sold after 5 years, you're gonna cash out 100 to 124,000 versus 190. Good. Same time period, 5 years, 25%. Again, your interest rate on this shared appreciation loan has been about 5%. Simple. Let's refi and get out of it. You still want to stay there. You like the house. If you refied conventional, you have 72% loan to value. Your rate's going to drop. You're likely, or else you wouldn't refi. But yeah, that's a great scenario. If the CalHFAs, that's so good. Get out of that shared appreciation loan if you can. But man, you might get mortgage insurance added on, and so it's just I'm thinking like if you can put the down, do it. But again, there's definitely cases where the shared appreciation loan is the way to go. So just want to show you the numbers. So if you refied, you'd probably refi, you'd come in with a little money or refi with a little bit of mortgage insurance. Yeah, that's probably what it looked like. One more scenario. Okay, let's say you had the big gain. Let's see, your price doubled over 10 years. So simple interest that you paid on that second of it's about 10% interest. So now it's like inexpensive. But your house went from $700 to $1.4 million. So you're happy. You decide to sell after 10 years. 1.4, you pay 6% to sell. Ooh, that's gonna hurt. But that is what it is, I guess. Your mortgage balances are lower and pay those off. You have to pay back that 140 you made plus another 140. So that's going to be 20% of 700, which we know because that's what our down payment was. But if you make 700, you get another 140. So you're going to pay back 280 on this shared appreciation loan. And you can see your proceeds are, a lot more with the conventional loan. So when you have this kind of hefty appreciation, which I'm not predicting, what do I know? That's when this cost will get quite high. But that's also when you're going to have the equity to, refi and get out of it. So this is what happened. You double your money in 10 years. This is what it would look like. And I'm not going to show you the refi one, but you can just see, you could simply refi either any of these options. You'd have a lot of equity. You refi to lower your rate, and you don't need to see that, I don't think. But just, I'd say if we do the shared appreciation loan, you'd want to look, exit sooner rather than later when you're able to. That'd be my thought. And I was talking to someone about this loan, and they're like, well, I'm not going to sell. Just not going to sell. I was like, oh yeah, good idea, man, don't sell. But really, the shared appreciation loan will also be due. It's not just salary finance, but it's also when you pay off your mortgage, or your shared. If you decide to pay off your shared appreciation loan, then it becomes due then. So if you pay off your mortgage, then it's due. So let's just say you made the minimum payments for 30 years. You never paid on that second. And you just had, let's just say, I just picked a reasonable number, 4% appreciation over 30 years. Your $700,000 house is going to grow to $2.27 million. That's the power of real estate. Amazing. 2.27, 4% over 30 years. And so you wouldn't owe anything because your mortgages would be paid, your first mortgage would be paid. But that shared appreciation loan, ooh, that becomes due. So guess what it grows to? You can see over $450,000. So I think, you know, this sharp appreciation, you want to get out of the shared appreciation loan, or also just holding it for a long time, you'd want to get out of it. Because yeah, it can grow to a big figure. So I mean, your mortgage is paid, the shared appreciation loan becomes due. So this is what it looked like. So if you gain 3% down, conventional, simple, you'd have 2.27 million to your name. You'd have the value of the house to your name. But the CalHFA options, you know, you'd have to subtract about 450,000 from that fee. So to recap, big positives of the CalHFA loan are that it allows you to be approved for a higher amount. Also, for a set purchase price, you have a lower initial payment. So you don't have any payment on that second loan. So those are the big positives. If you don't have any money for your down payment, it's a great solution. Fantastic. The negatives for it are that it's a little bit more expensive money in the sense that you have to pay the borrower paid comp, so the closing costs are higher. If you have a lot of appreciation or just hang on to that second for a long time, that the cost of that second could be quite high. You're also, just something to think about for all the scenarios that I listed, even the conventionals, that when you start out with very little equity, and you are in a negative, you know, environment where prices could decline, could be in that house for a while. So just something to be aware of. A negative on the CalHFA also, as I'm thinking about it, is the fact that the appreciation amount is based on the appraised value or the sales price, and they don't deduct out of there if, you know, you put a lot of money into the house. So if you're buying like a fixer-upper, or you have all these plans for these improvements, then just understand that, you know, you're going to have to pay 20% at some point when you sell or refinance on the appreciation. They're not going to subtract out all that hard work and money you put into the place. So it might not be a fixer-upper loan, but, you know, just knowing is important. So now you know. So any of my borrowers, you know, I'm going to present the loan. I'll give them the, you know, positives and negatives. Sure, give my opinion, but in the end, it's you know, I'm going to give you data, and you know, you can make the decision that's best for you. So I really appreciate everyone who watched this long. If you did, just to give me a little positive, you know, boost, just hit the like, and you can leave a comment. You can tell me what kind of videos you like. I appreciate you watching. You got all the way to the end. That's amazing. Hopefully this is helpful. Until next time, have a great day. Thanks so much. Bye.